Hi, everybody. I'll be providing just a brief overview of where we are as an economy at the moment, and also obviously touch on what our expectations are in terms of the medium policy statement tomorrow that's coming out. So just a quick update on economic growth. It has actually surprised to the upside. So far, we've received, data up to the second quarter of this year. And for both the first and the second quarter, growth has surprised to the upside. In the first quarter, this was as a result of an increase in consumer spending, government expenditure, as well as fixed investment. And in the second quarter, during the winter period, there was less severe load shedding, which definitely supported a lot of energy-intensive industries, and that supported the upside in terms of growth. We do expect growth to expand at a higher rate than expected at the beginning of this year. So growth is expected to come in at about 0.7%. We started the year at about 0.1%. Close to zero. So, and this is mainly as a result of load shedding being less severe as expected. But now just to touch on some of the upside and downside risks when it comes to our growth outlook. The first of these is actually still the energy crisis. The electricity shortage is a concern for us in this particular moment, and is probably going to be one for the rest of the year and for next year as well. The energy minister has highlighted that by the end of 2024, they would like to see load shedding cease, but that is still an uncertainty, in terms of whether that will happen or not. But what we've seen so far is that the load shedding that we've had up to this point has been more intense than what we saw in 2022, and this has definitely had implications. On the upside, however, it does seem that some industries as well as consumers have adapted to load shedding and, made use of alternative sources of energy, which have helped them stay operational and have supported activity so far. But overall, the electricity shortage still remains a drag on the domestic economy. Another downside risk for us is the slowdown in the global economy. So what we have seen is that, in 2022, 2021, inflation started to increase globally. And because of this, central banks have had to react by increasing interest rates. This obviously dampens activity and demand within an economy. An economy slows. And if our most important trade partners are slowing, that means there'll be less demand for South African goods and services. So if there's a slowdown in the rest of the world, it will affect us. And we do expect the slowdown happening in 2023 to have implications for us. Some economies will do better in 2024 are going to do better than initially expected. But overall, it's still below pre-pandemic levels, and that will affect us. Now next, the fiscus. This is obviously a very contentious topic right now. The latest numbers coming in from the National Treasury actually show that the fiscus is under significant pressure. Expenditure is increasing and revenue has declined quite significantly. The decline in revenue has been as a result of corporate income taxes being super low. They've actually contracted quite significantly, over the past few months. And this is as a result of the slowing domestic as well as global economy. Conditions are not as accommodative as they were in the previous year. And this is definitely coming through in terms of the revenue that companies are able to generate. Taxes on goods and services on the upside, however, have continued to grow quite strongly, but I think because corporate income taxes account for such a big portion of the tax base, overall tax revenue has fallen. It's contracted by about 0.2% as of the September number. Expenditure has increased by about over 9% up to September, which is quite significant considering that revenue has contracted quite a lot. And most of this is as a result of the wage bill as well as higher debt service costs. Interest rates have increased quite significantly over the past year or so. And this has definitely affected or increased how much we pay towards servicing the debt that we currently have. On the upside, however, for the economy, there are some upsides. Fixed investment has remained quite strong over the past few quarters, and most of this has been as a result of companies investing in alternative energy and ultimately investing in alternative energy, and that has definitely supported the economy. And we expect that to continue because load shedding is definitely not going away anytime soon, despite what the minister has said. So more and more companies will probably, try to get away from their dependence on the grid in order to support their activities. Inflation. So inflation has fallen within the Reserve Bank's 3 to 6% target range, which is obviously what they ultimately want. It isn't near the midpoint of the target range, which is that 4.5 percentage point. That's where usually they want it to be. That's the ideal. Let's call it the sweet spot for them. But the fact that it has fallen within target is a good thing already. But there are some upside risks when it comes to inflation. The El Nino phenomenon is something that's being talked about quite a lot. And obviously, El Nino affects the production of food. So if that continues and if it materializes at a more significant rate than expected, food could become more expensive and that could drive food prices higher. We've also seen oil prices increase just a little bit with everything that's happening in the Middle East. It also raised concerns about whether, other countries in the Middle East would be involved in the conflict between Israel as well as the Palestine, and whether that would have implications for oil prices. But for now, that is definitely not something that we actually see materializing. But it is an upside risk that we should definitely consider. In terms of what we see for interest rates, the SARB increased interest rates by about 475 basis points since November 2021. And they've left interest rates unchanged for the past 2 meetings. We don't expect them to increase interest rates any further for the rest of the year. And this will definitely provide consumers with some reprieve. And in the coming year, we expect a cut of 100 basis points, the first of which we're expecting to happen at the end of the first quarter, so around March. So interest rates are still going to be higher than they were pre-pandemic. So there's still going to be some pressure coming through on the consumer. But overall, there will be reprieve. And, that reprieve should offer some upward support when it comes to demand. And that will ultimately also come through in terms of the growth numbers. So that's it from me. Thank you.
Thanks very much, Leandra. Very interesting and nicely summarized, I think. We just got a few questions, I guess, on some of the things that you discussed there. The one is about the government expenditure. So we know that they ideally need to reduce that. They've mentioned before that they are not going to or don't want to reduce payments for social grants. They don't want to reduce the expenditure on things like infrastructure. So realistically, how are they going to reduce expenditure? In which areas do you think that they can reduce the expenditure?
That's a very good question, obviously. But I think it also just highlights the difficult position that government is in at the moment. And this is a position that we find ourselves in quite a lot, where, expenditure is increasing at a faster rate than revenue is, and now we have to cut. And the unfortunate thing is that in an economy that is slowing, you would expect there to be a lot more government support. And unfortunately, we don't have the fiscal space for that. Yes, they did come through and say that, no, when it comes to social grants and infrastructure investment, they don't want to cut that, which makes absolute sense because our infrastructure, we can't afford to cut that because it's already so inefficient. So they definitely need to do a lot more work when it comes to that. But ultimately, this could raise the question of whether the cuts will come from the social services side of things, which as well, that's an issue when it comes to health services, and support in terms of the less fortunate. There can't be cuts there as well, but that's probably where it's going to come from, probably from health. So everything not related to economic development, because we need that more than anything right now. So when it comes to social services, we're probably going to see cuts in terms of health, maybe in terms of peace and security as well. The government also has a contingency I think they saved about 5 billion rand under that contingency sort of bucket. Maybe they could, seize that for a while, because that's something that they didn't have in 2020-21. But yeah, overall, I think most of the cutting will definitely come from the social services side of things, which it's unfortunate because we actually can't afford to do that. But they have to find the right balance between, continuing to invest in capital spending, because we need it for economic growth, and to create an environment where businesses can thrive, jobs can be created, and also not sacrificing too much when it comes to social services. So it's a difficult question, but yeah.
So I guess that linked to that a bit is, how do they finance that debt? So we know one of the things that has been good, I guess, for the government historically, how do they finance themselves? Generally, they go to the market and they issue South African bonds. And generally, those bonds have been denominated in rands. Right. And I think only about 6 or 8% of South African government debt has been in dollar-denominated offshore bonds. Going forward, I think they're finding it tough, given the economic and political climate in the country, to raise funds like they have historically in South African rands. Does that mean they're going to now need to go and look outside into offshore markets in dollar-denominated rand or government bonds? And what are the implications?
Possibly. I think there are two options when it comes to them approaching the market in terms of funding. Firstly, if they do continue to extend bonds in local currency, they might actually find that they'll do so at a much higher premium because of the risk attached to the South African economy in this particular moment. So it'll be a lot more expensive, even if they can definitely, get that funding in local currency. If they do decide to go the foreign currency route, there are some risks that they have to consider, specifically exchange rate risks, which will raise the debt service costs even more. They'll rise either way, whether it's in local or foreign currency, because of the risk premium attached to the South African economy right now. But overall, I think the risk premium is something that will drive debt service costs higher either way. And in terms of foreign currency loans in particular, the foreign exchange risk, considering the volatility of the rand, will have significant implications on the cost of servicing that type of debt.
Just a follow-up question, I guess, on that is, we know the government has paid out about 250 billion to Eskom, and we wait and see, hopefully, that they can get Eskom back on track. The next key thing, and we've spoken about sort of structural reform, and the big problem in South Africa now is also logistics and the railways, Transnet. So Transnet has now asked the government potentially for up to 100 billion rand in bailout money. Given that logistics is so vital for economic growth as well, how do you see government handling this? Will they have to pay them this 100 billion? And again, where's this money going to come from?
Transnet, like Eskom, are institutions that are too big to fail. They are too critical for the South African economy for the government not to offer assistance. And unfortunately, when it comes to Transnet, again, because of the inefficiencies when it comes to road, rail, and ports, they are the ones that are responsible for that. And those are literally the drivers of the South African economy. So yes, we do expect government to provide that bailout assistance, because if they don't, then we're just going to continue to see a deterioration when it comes to infrastructure in the South African economy, and it will have more long-term implications in terms of economic growth. So yes, they are it's too big to fail, literally. It's just say it in financial terms. They're gonna probably, offer Transnet the money that they're asking for. There will be conditions probably attached to it, in the same manner that they attach conditions to the money that was given to Eskom, but they will definitely give the money. Where is the money gonna come from? Again, raising taxes in this economy just makes absolutely no sense. So it will definitely have to come from them cutting from important functions, some of the other important functions, ultimately. So, yeah.
Leandra, thank you so much for your time. coming out to present and all your informative comments. We appreciate it and look forward to seeing you again.
Sure. Thank you, Trevor.